people are already uncomfortable with it, and they've already created an asset bubble, financial bubble. If that financial bubble cracks, they're going to look around next time and they're going to say, what else can I own that might be safer, that might be more real? And I do think they'll look at gold. I do think they'll look at real estate. I do think they'll look at hard assets. I'm not convinced they'll look at digital Pokemon, but they might.
Thanks for joining us for part 2 of our interview with fund manager John Hussman. If you haven't yet watched part 1 of our discussion with John, in which he explains why he thinks we're in the largest asset price bubble in U.S. history and that a disappointing decade lies ahead for unprepared investors, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment perspective that John and our partners at New Harbor Financial share in this video. And please, take just a moment to support this channel by first liking this video and then clicking the red subscribe button below, as well as that little bell icon right next to it. Doing so is easy and it helps this channel reach a lot more viewers. Okay, let's get started watching part 2 of our interview with John Hussman. It looks like you are looking ahead at all the data and saying it looks like we have basically a lost decade ahead of us. Right, where either, and this is probably the best case scenario, valuations.
You get a lost decade if we limit the contraction in valuations to the 2000 high.
Yeah, exactly. Yeah, and best case scenario, we just the current valuations don't go anywhere for a decade, right? And this kind of things kind of catch up to fair value over time, or we have just a really big correction in there, or probably more likely real ping-ponging around it.
We'll definitely do that. We'll definitely go nowhere in an interesting way.
And I want to let you run on that, but I just want to note one thing that you said here. So you've said, I expect the coming decade, and most of the damage will come from the top, resulting in market conditions that are reasonably investable within a year or two.
Sure.
So kind of where I'm going here is two things. One is, I read that and it sounds a little bit like Jeremy Grantham, which says, hey, when we look at history, when we've seen these conditions, we usually see a market correction of 50% plus coming sometime soon. Yep. So I hear you saying, hey, look, there's pretty good possibility of a large market correction. Mm-hmm. But then I hear you saying, but there might actually be a period not too long after that where we can look at some green shoots and we can start to deploy capital.
Yeah. Oh, absolutely. So it's really, this is a really good question because it's an important point for investors to understand. When we look at these very, very long periods where stocks went nowhere in an interesting way, and in fact, if you look at I think 80 years from 1929 out to 2009. Over 50 of them were comprised by 3 spans in which the stock market underperformed T-bills. The S&P 500 in total return underperformed T-bills. 50 of 80, more than 50 of 80 years, right?
Wow.
So that's just what overvalued markets do. On the other hand, it's important to understand how those long periods actually unfolded. They were not 18-year periods where you didn't have anything to do, right? If you look at the 1929, market collapse, right? So we had 1929. The market lost, close to 90% of its value, in the Depression. Only about half of that. So that big decline that we had was actually 2 declines of 2/3. One of them was actually just a return to historical norms. And then the second loss of 2/3 of that was basically because of policy errors and banking crises and all these sorts of things. But, even after you got through that was 1932, and you were back off to the races. Now you had another decline after 37, but then, by 40, boom, you're off to the races again. So these very, very long periods of time are punctuated by periods where stocks, get hammered, but then you get a combination of retreat in valuation meets improvement in market internals. If you look at what we did after the 2000 market collapse, what you'll see is that we lifted the majority of our hedges in early 2003. Because even though the market was profoundly overvalued, and I wrote in March of 2000 that we expected an 83% loss in technology stocks, and we got it. By early 2003, we had a substantially lower level of valuations, and we had an improvement in market internals, and so we lifted our hedges. If you look at what we did after the 1990 bear market, I not only lifted our hedges, but we actually established a leveraged position for years. People don't know this about me because they think they know me as a perma bear. Right? In late 2018, we actually lifted a good portion of our hedges as well. We got a little spanked, and that led me to to do some stress testing and that sort of thing, which then had this unfortunate side effect of convincing me that these overextended syndromes were important at exactly the wrong time when the Federal Reserve disabled them. That's sort of an unfortunate wandering through this particular cycle. But the fact is that in late 2018, after the market had collapsed over 40%, late 2008, we had a combination of a retreat in valuations and an improvement in market action that encouraged us to reduce our hedges, right? So these things will happen, right? We will get that in this cycle too. And 2007, by the time you got to 2009, you had investable conditions again. So when I talk about 10-year periods and possibly 20-year periods where stocks are likely to underperform T-bills, that is measured from this precipice. That is measured from this point, right? But if we drop substantially, then, even if the market goes nowhere in an interesting way for a decade, we drop down here and we get not only the growth, but we also get the recovery in prices, and then you get a good return measured from the low. And so both things can be true at the same time. You can be in a situation where stocks are likely to do poorly for 10 to 20 years, and yet 2 years later, you're at another level of valuations completely, where you get the combination of a retreat in valuations plus an improvement in market internals, ideally oversold conditions, ideally credit spreads come down, ideally some of these other measures of risk aversion come down, and you say, oh, you know what? Now we've got good valuations and the risk aversion is abating. Let's become more aggressive. In every other cycle, we did that. I kind of got blown out of the water by a few things in this cycle, but the main one was that once interest rates hit zero, the limits came off, and so we've adapted to that. We've altered our discipline to the point where next time we see this retreat in valuations coupled with an improvement in market actions, our hedges will come off too, as they did in 2003, as they did in 90, as they did in late 2008.
Oh, so that's great. And, just like you say, people unfairly paint you as a perma bear. We on this channel, we spend a lot of time warning people about current conditions, and we get sort of painted with the doomer brush, right? And really, John, I just think guys like you and I really call us pragmatic opportunists.
It's been a long time, though. We've been watching this thing for a long time, and so it is. If you look at where valuations were, even in 2012, stocks were priced in 2012 for poor long-term returns. The problem is that they went from poor to dismal to horrific. Right? Yeah. And as you drive down the long-term return, you're driving up the price. And so now we're at a point where prospective returns are horrific, we can't say that it's the end. If market internals improve, even I will say, well, we might have a little more to go here. But right now, I'm very concerned because we've got all of these extreme conditions plus some likely pressure on profits and so forth.
Yeah, no, absolutely. And all I was going to say is I see us as pragmatic opportunists. The problem is the opportunity has sucked and has just continued to suck more and more from our perspective. But when we see, the coast being clear to deploy capital, we absolutely want to do that. And so I'm just going to mention, John, so every week on this program, at the end, I bring in the folks from New Harbor Financial, which is the financial advisory firm that's Wealthion endorses. You know these guys already, John. John Lodra and Mike Preston. I'm going to bring him in a bit early this time around simply because they are huge followers of your work. I know they have a couple of questions for you. Sure. I do want to, after they ask a question or two, I do want to get to the key questions of sort of where you see, well, one, what you think folks should do to try to avoid from becoming roadkill right now. And then two, where you think the opportunity is going to lie over the next decade. But before we get to those two questions, Mike and John, why don't you guys come on in? John, let's start with you. Question here of your hero, John Hussman here.
Sure. Well, yeah, hero is.
How you doing, John?
Hero is certainly a proper, title that we would bestow upon John. He does great work. He's a very generous man in his research and his time and his humility, and we appreciate that about him.
Oh, thanks.
We could fire away for hours here, John, because we are big fans of your work. But I think what is most present on my mind, we talk with retail clients every day. Our clients are individuals, families, couples. So we have the unique privilege, I suppose, to really get into the lives of these people and try to translate what we see and analyze in markets that certainly everybody from the Federal Reserve to the CNBC tries to confuse the issue from the arithmetic that you so nicely point out. So one of the things that's present in a lot of folks' minds today is this concept of there is no alternative, but now you got the specter of inflation thrown in. So it's another reason for folks to think there is no alternative but to be in the stock market. Now, I know, and we know, and you know from your research, but I wonder if you could speak to this concept that cash is a horrible place to be in an inflationary environment, relative to the textured nuance of stock valuations as a better place to be or not.
Yeah, it's interesting. If you actually look at the historical data in the US, what you will find is that if you look at the S&P 500, if you examine its total return during periods where inflation is rising, so the year-over-year rate is higher than it was, say, 6 months earlier, right? As long as the inflation rate is over 2%, stocks have actually underperformed treasury bill rates during those periods. And the higher the rate of inflation, the more stocks have underperformed, right? Because the first casualty of inflation is stock valuations. And the nominal growth that you get from the inflation doesn't supersede the contraction in valuations until valuations have been normalized. And so what you see in periods, especially where stock valuations are high and inflation is rising, is that you don't get a good return from stocks, that the growth in nominal cash flows is not enough to counter the downward pressure on valuations. So that's probably the first thing. The second thing is, and this is something that I find in my own work, even though I write regularly, I write monthly, we do our analysis, constantly. So I would actually think most of what I do is it would actually be termed hedged equity. And so, so I have strategies, for example, an asset allocation strategy that I follow, that I look at individual stocks and try and decide, how much equity exposure should I have, how much bond market exposure, how much should the equity exposure be hedged, right? And those are things that, for me, I do every day. I can't write enough for someone to actually make those changes. And so when you're talking to a client and you're saying, well, we've got you in cash here, that's going to be very uncomfortable for them because they're going to say, well, when is this going to end? My best answer to that is it's probably better to be doing something hedged than being completely in cash if you've got if you've got reasonable expectations that what you're hedging is value based. So I like value based hedged equity. I think that a small portion, especially of institutional portfolios, should probably be in managed futures. I do have some ownership of Treasury inflation protected securities, although those have run up quite a bit, and we've got some farmland and that sort of thing as well, in our family holdings. So you can respond to an inflationary environment without saying, well, my answer to this is stocks. But even more than that, I think what Adam was saying is exactly right, that we have to be in this environment opportunistic, right? We have to be opportunistic, and we have to think about the market in terms of not only the valuations, but also the speculative pressures, right? Right now, I actually think that over the next decade, passive investments will do less than zero in the U.S. equity market. I think that you'll actually have a loss in total return. So cash right now has enormous option value. Why? Because if the market does retreat, you can allocate that capital. You can put that capital in, and you don't have to put it in all at once. You can dollar cost average in. If you've got a client who really wants to own something, you could start dollar cost averaging very low right now. Even they're probably loose on those initial investments, but doing something may prevent them from throwing everything in all at once in a way that really harms them. So my view, in terms of, for example, how a financial planner might approach things is to say, look, we've got a market that is extremely overvalued. We've got bond yields that are next to nothing. We will put some amount of assets into passive investments, dollar cost average in, but do it very slowly right now. And if we get a retreat in valuations, and if we get an improvement in market action and so forth, we will accelerate that. And likewise, we'll also hold some alternative assets, ones that have some flexibility, ones that are more opportunistic and have a variable market exposure. And I think the combination of those two things, a small averaged in passive exposure plus alternatives, will be, I think, more comfortable than having nothing. Although I really do think the early passive investments in the market are likely to be losers. I think we are at valuations that make it very difficult for an initial allocation in stocks to be successful. So you may want to defer some of that until we get at least some moderate retreat in valuations. Again, we're at levels that are 50% higher than the highest level of valuations that we ever saw before last year.
All right. Hey, John Hussman, I think your check's in the mail from the guys at New Harbor there for saying that passive investing will probably do less than zero over the next decade, because that's a great endorsement for somebody to work with an active professional, right, who can put together an actively managed portfolio for them. Mike, do you have a question here for John?
Yeah, I'd like to maybe make a couple comments than a question, and I'm just fascinated by this talk, and we're fascinated by your work, John, and we can't emphasize enough to people, and we say it to almost every prospect and client we talk to read John Hussman's work.
Oh,
You know,
thanks.
there's not very many voices of reason out there, and I could count them on a lot less than fingers on one hand. You know, if you're looking for truth, if you're looking for analysis backed by real data, if you're looking for something to help keep your sanity, check out John Hussman's work. You can get to it. I'm sure John will say it later, but
Well, you can
Hussman.com.
follow my Twitter account too, Hussman
Yeah.
JP, Hussman JP. I post my comments as well as random thoughts on just about anything, including medical papers on COVID, which people don't know how much scientific background I have, but I published 2 of those last year.
Yeah, and
Quite
I
a
do.
bit.
It's an amazing amount.
Yeah, so you hit on a bunch of points I just want to mention here, John, and then I will get to the question. I mean, I'd like to maybe throw out some quotes from your piece today that I thought were really good and prescient. And you were quoting Jeremy Grantham quite a bit too. And Jeremy said, you know, people don't remember what you sound like when you're serious. One of the disappointments, I think, in our time during this bubble is that we're pounding the table, backed by real data, warning people. It hasn't mattered, right? It hasn't mattered.
No.
And it's until it does. Right. So, but we're dead serious and have been dead serious, you know, every week on this program, you know, and in our conversations with people for the last few years. And you say amplifying a bubble doesn't avoid its consequences. You know, it's right. And all speculative bubbles collapse. You know, it's amazing. I didn't think that we would be able to see more extremities in terms of euphoria and psychological distress in this year than we've seen in previous years, but indeed we've seen them doubly, you know, strong.
Yes.
You know, we all kinds of stories from prospects and clients that are hearing their friends and neighbors brag, you know. And another thing you say in your piece, bragging is a symptom of the crest of the mania, you know, and that's been going on for a long time.
Yeah, this wealth that people see kind of popping up around them. They're imagining that it's a brave new world. And what it really is, if you look at prior bubbles, it is the symptom of a speculative bubble that is cresting, a speculative wave that is cresting. We saw exactly the same stuff. You know, Grantham called it crazy behavior. I mentioned a couple of examples in my market comment from 2000, where, you know, these stocks rise from nowhere. Back in the late 60s, John Brooks, who wrote the book called The Go-Go Years, called them the shooters. You know, these securities that would double and triple in a few weeks. And so those shooters, those, you know, speculative boom, wealth out of nowhere, it looks so attractive, but it's actually a symptom of, you know, a speculative mania, and badly.
It's been really hard to deal with for everybody, you know, money managers, individuals, everybody. And, you know, we think that everyone's going to pay the consequences of it eventually. And you know, analyzing your words, you know, you talk about, you know, dollar cost averaging, you know, the time for passive investments is long gone. We couldn't agree more. It really gets to what we think is a psychological war game, for lack of a better word. You know, the Fed has doubled and quadrupled down on these same policies. You say in your piece, at every point, the Fed, instead of reducing the ultimate aspects of this bubble, have chosen to double down every time. Yep. And to us, it's absolutely psychological mind games, and it forces money managers to consider game theory. Well, hey, if we do a little bit of this, you know, over here, it'll relieve some of the pressure, and it will keep a client from damaging themselves more. I mean, I can't tell you how many times we've had that kind of discussion and arguments with even each other and people in our business, our peers.
Yeah, ultimately, no, and you do have to make those decisions of you know, I mean, you know, for me, I know what my role is. I manage alternative strategies. My expectation is that people may have some portion of their assets in passive, and they use me in the alternative bucket. You know, or something like that. But I know what my role is, even, you know, when people, you know, throw stones at me. I know what I'm here to do. I know what my strategy is. You know, I've adapted to what I had to adapt to. But for someone who, like you, who's managing the full portfolio, then, you really do have to think of, what can I do to allay my clients' distress, but also do the right thing for them. And that I recognize the difficulty in that. And I think part of it is, for you, I think you have to have some diversification in, some amount, as much as you may expect, and I do, that certain passive investments are going to lose. A diversified portfolio doesn't impose too much of an expectation on having zero. Again, for an alternative strategy, discipline like us, that's kind of what we're supposed to do. But for a full portfolio, you have to make those sort of game theory choices. Yeah, I think that's exactly the right phrase. It really is. When people are talking about, I'll mention this, and it kills me. That people are saying, well, maybe I'll just have 1% of my money in crypto.
Yeah.
Well, the problem there is that if everyone was to have 1% of their money in crypto, if everyone was to have 1% of their money in dirty socks, I guarantee you that the market capitalization of dirty socks would be 1% of the total market capitalization of all assets. It must be true mathematically, right? So this idea that I'm just going to put my money into something that that is frankly essentially an electronic Pokemon, right, or an electronic Beanie Baby, that is not a substrate of the banking system, unlike base money. Every transaction you uses base money, and that's why it has value, because there's a small transaction benefit that you get from holding base money, whether you like it or not, because it's used in so many transactions. Bitcoin, 2,000 transactions every 10 minutes, and you're done. It's got no bandwidth, and it is burning up enormous amounts of energy. So I know that someone asked what my opinion is. I'm not a fan. I think cryptocurrency is basically a symptom of central banks having degraded the confidence in fiat money, and I think it's also a misinterpretation of why currency has value. And it has value, that fiat component, the requirement that it is a substrate of the banking system, is what gives fiat money value, right? So you can't just create, an electronic Pokemon and say, well, hey, look, I've got one of these too. We all use electronic currencies. We do it right now. All of us own electronic currencies. It's called the US dollar because base money, right? Bank reserves are nothing but electronic currency. It may not have the cryptographic features, but the reason it has value is because it's a substrate of the banking system. People will figure this out, but in the meantime, when the Federal Reserve has just degraded people's psychology and degraded confidence in the currency, you're going to see a lot of behavior, right? And so you're going to hear your clients asking to be in crypto, and you're going to have to play that game theory, and you're going to have to go, geezy peasy, really? Do I have to do this in order to allay their FOMO when these digital Pokemon advance in price? I don't know how to answer that. I'm glad I'm not in that particular aspect of the business.
Yeah, I'm going to chime in here, John, just to say I have counseled the guys a lot here that, being good in their jobs, which they are, they have to basically be, therapists and psychologists just as much as they have to be financial professionals. And I see a nodding here. Hey, since you went there,
I'm sorry, Mike, I'm not sure I answered your question though, because I jumped in.
I will get to the question. It seems like you were in the middle of saying something, Adam.
No,
Yeah, just real quick, because since John went there. So thank you for sharing your thoughts about cryptocurrencies. That was one of the questions, just because that's a perennial interest here of the viewership. What commentary do you have about gold? So, when you talk about crypto being a symptom of loss of faith in, the currency, given what the Fed's doing, gold is oftentimes, held for the same reasons. Do you feel it has more of a role? I don't want to put words in.
So first of all, and I should be very clear about this, the blockchain algorithm is an extraordinarily useful algorithm. I think it will be used for a lot of things in the future. You can use it for inventory tracking. You can use it for, basically
smart contracts, all that stuff.
Yeah, all kinds of things. So I'm not saying that cryptographic, right? Security and these sorts of things have no role. I'm just saying that these digital objects that are produced, unless you really, unless you really have some use for it, right? The value derives from use or aesthetics. Beanie Babies aren't necessarily useful, but they have aesthetics. The kids loved them, right? People love Beanie Babies. There was a point where the aesthetic was worth much more. Now it's less, but they're still valuable. They still are. They're not zero, right? The cuter ones, anyway, right? Because they have some aesthetic to them, right? Gold has not only industrial uses but also aesthetic uses, and the aesthetics go back centuries, and the use as a store of value goes back centuries. And so there's a certain it is partially cultural, right? But there is a certain value that people have for gold, jewelry, and that sort of thing, as well as industrial uses, right? And so gold itself is, has features of a commodity, right? The cryptocurrency is a commodity as well, but it has neither of those features. Now, it has some, right? You can use crypto for black market transactions. So somebody's going to use it. Somebody wants to hold it, and over short periods of time, it's going to be valuable to people to do whatever the hell they're doing, and with cryptocurrency. But what I can tell you for sure is that the bandwidth of blockchain is roughly 2,000 transactions every 10 minutes, and takes an enormous amount of energy. And every time somebody gets that SHA-256, code to validate a block of transactions, everyone else's energy is wasted, and you start at zero. And that's a problem ecologically. And so I'm not a fan, frankly, of Bitcoin in particular. Some of the other cryptocurrencies, frankly, are amusing, and I think they are speculative amusements, kind of like Beanie Babies, but with less aesthetics. I can't say they're not going to go up, because again, if people want to invest 1% of their portfolios in a hamper of dirty socks, and everybody does it, that hamper of dirty socks is going to be worth 1% of the asset market. So I can't say that they're going to zero over the short term. I suspect a lot of them will go to zero or nearly zero over the longer term.
All right. Well, you're making me excited to launch my new NFT series of dirty socks. So I'm doing that as soon as we get off here. Mike, let's go to you to let you ask whatever question you wanted to, and then I'll try to wrap this up. But it looks like we're on a track to have a 2-hour discussion with John Hussman here, which is like the coup of the internet.
I miss you. I haven't seen you since, California years ago.
Long time ago.
It's very nice to see you guys.
Wine country, right? Yeah, my question was basically about gold and real estate. I mean, I'll get right to the point. It's because of the psychological torture people have been going through. We're heavy cash. We are playing the game around the edges, but we're heavy cash, like we think we should be. And we strongly advocate real assets, not to go out and speculate or leverage in real estate, but owning your own home, maybe even paying off the mortgage makes sense, and having a core position in precious metals. Other real things too, like farmland, maybe, but gold and silver is the easiest thing for most people, and real estate. So just wanted your comments on that. Thanks.
I agree with all of the above. I mean, in terms of my own portfolio, obviously, most of my liquid assets are invested in my own strategies. That's the way I prefer it. That's the way I've always done it. I got nicked in this cycle, but we've done well over the long term. In full cycles in the past, and my objective is full cycles in the future. So I do like strategies that have the ability to vary their exposure and that are generally invested in value stocks, value-oriented stocks at all times, and basically just choose how much of the beta, how much of the market exposure to hedge. So that's one part. But I completely agree, with having some amount of assets in precious metals, some amount of assets we live on an old horse farm, so I've got that one covered in terms of, in terms of farmland. In terms of having real estate, I think over the longer term, you will get appreciation. We have had a run up in real estate. It is a little bubbly in terms of residential, but I think over the longer term, that is going to be an important hedge, basically because if 27% of GDP, let me put that in context. Historically, in order to regulate interest rates, in order to affect interest rates, the way the Federal Reserve has done it is to create a certain amount of zero interest money. Because, as you create more zero interest money, people chase yield. That's actually how the Fed changes interest rates, right? It creates more zero interest money. And by doing so, people say, well, what can I hold instead? And so they bid up T-bills and they bid up, other competing assets that are yielding something. And so you get what economists call a liquidity preference curve, right? Where the more zero interest base money you have as a share of GDP, the lower interest rates are. The less zero interest money you have, the higher interest rates are. And you can do a scatter plot of that, and it's beautiful. The problem is that in order to get 2% interest rates, you can't have more than about 9-10% of base money per dollar of GDP, unless you actually go out and explicitly pay banks interest on their reserves in order to jack those interest rates up, which is what IOER is, interest on excess reserves, right? That's what the Fed had to resort to. Why? Because it didn't stop at 10. It didn't stop at 12. It didn't stop at 15. It went all the way out to 27% of GDP that is in zero interest, zero interest liquidity. So it has bought interest-bearing securities, replace them with zero interest base money that somebody has to own. That money isn't going to go into stocks. It may go through stocks, but the minute you take your base money, your zero interest money, and buy stocks with it, guess what? The person who sold you that stocks has to hold the stuff. It's not going away. It's not going into anything. It might go through all kinds of things, but it's not going into anything. It's going to stay base money on the sidelines in a stack until the Fed gets rid of it, or until nominal GDP grows enough to bring it back down to a reasonable fraction of GDP. And my suspicion is that that's part of what we've got in our future. So to get from 27% of GDP down to 9% of GDP, you have to triple your CPI, or you've got to have the Fed go backwards in their balance sheet. It's not clear which one will occur. I suspect it'll be partially both, but my sense is that when you're looking at this much deficit finance that has been funded by essentially printing money, people don't like to say that, but if you buy the treasury securities and you never retire them, guess what? You've printed money, right, to finance the deficits. If you never retire, you've printed money, period. And you've printed money until you retire, right? It's just the way it works, right? So the Fed has printed a bunch of money. It may or may not retire it, but people are already uncomfortable with it, and they've already created an asset bubble, financial bubble. If that financial bubble cracks, they're going to look around next time and they're going to say, what else can I own that might be safer, that might be more real? And I do think they'll look at gold. I do think they'll look at real estate. I do think they'll look at hard assets. I'm not convinced they'll look at digital Pokemon, but they might. But this is something that investors have to think about, and most of all should have parts of their portfolio dedicated to, just in case you get that. So I don't think I've had a zero position in gold for 20 years. I've always had something in.
Wow, thank you for giving such a detailed answer there, John. Folks, we normally say goodbye to our guest, and then I follow up with John and Mike here from New Harbor. We're going to break the format this time just because we've gone so long. But
we're going to jump into show tunes. No,
yeah. But as if you gathered from this discussion, they actively manage client portfolios, taking an awful lot of what John Hussman does, writes, publishes, forecasts into account. If you want to learn more about what they do, and they also offer free consultations. They don't cost anything. You don't have to work with the guys. They'll just sit down with you, hear what you're looking to do, look at your personal situation, and they'll tell you what they think, would be good for you to do. You can do it yourself. You can do it with your existing advisor, or if you like them, you could work with them. If you want to find out more about that, stick around at the end of the video. It's coming up in just a couple of minutes. We tell you how to do that. It's very easy and quick. John Hussman, as we wrap up here, for folks that have enjoyed this incredibly generous nearly 2 hours you've just given us here and would like to follow you and your work going forward, where should they go?
Like I say, probably the easiest place to get sort of my regular thoughts is look me up on Twitter, Hussman JP. You can also go to Hussman.com and you'll find a bunch of our projects, including Hussman Strategic Advisors, which is my advisory firm, and so forth. So.
Awesome, excellent. And when we're editing this, I'll put up the handle to both your Twitter your handle and your website there. And if it's okay with your your compliance folks, John, I'm going to put a downloadable PDF of your latest market comment on our site with a big button of where folks can go to actually sign up to get more of those in the future.
Sure. Yeah. No, that's absolutely fine.
So to get that free download of John Hussman's most recent market commentary, the one that we've been citing so often through this discussion, just go to wealthion.com/Hussman or click on the link provided in the description of this video below, and you can get it there for free right now. All right, John Hussman, look, I cannot thank you enough for coming back on the program. I know you're such a busy guy. I know you had a lot of commitments, but I'm so glad you made the opportunity to come on here. It was wonderful. And now that we're coming out of COVID, and I hope your commentary about the fact that we're sort of at critical mass now, vaccination wise, that unless God forbid there's another super strain that comes out, we should be putting it largely in the review. Yeah. Well, hopefully that just allows us to all get together in person at some point in time. And I got to tell folks,
looking forward to that.
Yeah, John's not only a superb financial analyst and also a super knowledgeable PhD on tons of topics, but including medical research, and the work that he's done around COVID is absolutely stunning.
And also autism and a bunch of things. So the foundation does a great deal of scientific research. We have research labs in neuroscience and Hussman Institute for Human Genomics at the University of Miami. So that's kind of what I do with my income is to fund charity. and work on, important things, autism. We've done some work in COVID over the past year, looking at Alzheimer's, and the Institute for Human Genomics does a lot on that. If you're interested in that, go to the Hussman Institute for Human Genomics at the University of Miami. But yeah, happy to join you guys.
So brilliant guy, philanthropist, man with a heart of gold, making me and the rest of the guys here on the program wondering what the hell we've done with our lives. John is also a phenomenal guitar player, just to add to the list of his Renaissance man capabilities. I think folks watching have already gotten a great sense of just what a wonderful human being he is. But John, thanks so much again for coming on the program.
Oh, it's a joy. Nice to see all you guys.
All right, John and Mike, thanks for coming on, guys. Everybody else, thanks for watching. We'll see you next time.
Thank you.
Thanks, John. Great to see you again.
Thanks.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to Wealthion.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the Wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to Wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.